Today, we're going to go into the yield curve. Why, when the yield curve uninverts, it signals imminent recession. We're going to go into open interest, which has collapsed in gold down to into 470,000 something. And I'm waiting for about 450,000 to make the all clear. Not necessarily precisely all clear, but if we get down to 450,000, I don't think that we're going to have a collapse in price much beyond that. We're pretty close as it is, and we've had a minor short squeeze, which I will show you in the charts. Gold is outperforming commodities. The gold to commodities ratio continues to rise. Gold to CRB is now at 9 and climbing. Bank reserves have jumped higher this week with a weekly change in the top 10 or 11 of weekly changes since 2008, which means there was a massive influx.
The financial landscape is poised for significant shifts, with market analyst Rafi Farber highlighting the critical indicators to watch. The yield curve, a key economic signal, is nearing normalization after a prolonged period of inversion. Historically, recessions have closely followed this uninversion, signaling that the Federal Reserve may soon be compelled to cut interest rates to counteract an economic slowdown. Farber warns that such measures often arrive too late to prevent a downturn, raising concerns about an impending recession. A critical factor in this unfolding scenario is the decline in reverse repos, which have recently fallen below $300 billion, a point emphasized by Farber. Reverse repos represent surplus cash in the banking system, and their depletion signals that the extra liquidity injected during the 2021 stimulus measures is nearly exhausted. As these funds dry up, the burden of financing government debt will shift to bank reserves, potentially triggering a financial crisis if reserves drop too sharply. Farber also draws attention to gold's recent outperformance against other commodities, a trend that underscores growing economic uncertainty. The gold to commodities ratio has climbed to new highs, reflecting concerns that a recession is on the horizon. While other commodities falter, gold's rise serves as a clear indicator of its role as a safe haven asset in times of economic distress. The U.S. Treasury's plans to increase bill auctions, particularly in October, could further strain the financial system, a development Farber is closely monitoring. As reverse repos are depleted, bank reserves will be the primary source of funding for these auctions, accelerating the drawdown of reserves. This situation could lead to a new financial crisis, potentially prompting the Federal Reserve to launch a final round of money printing, which Farber believes could drive gold and silver prices to unprecedented levels. Now we'll show you the best clips of the latest interview, but first hit the like button, subscribe to the channel, and share this video with a silver bug. Enjoy the episode. A silver
uninvert, or we're about to normalize. Some people prefer the term normalize. I don't prefer the term normalize. I prefer uninvert because it reminds me of belly buttons moving from innies to outies, which is more entertaining for me. So that's the term I use. I have very specific reasons for the language that I speak, apparently. So we have this yield curve, and it is about to cross above the zero threshold. We're at 5 basis points. We can see here we're almost touching the zero. And recessions, as you can see here, they happen after the uninversion, after the normalization, usually between 6 to 8 months afterwards. We saw that here. We saw that here. Shortly after the normalization or going into positive territory, that's when we saw the recession take hold. It happened the last 3 times over here, and over here. That's 1989, 2000, and 2008. Now we're about to cross over into positive territory for the first time since June 2022. This is the longest we've had an inverted yield curve ever. On in gold and open interest, well, we have some encouraging developments here. We have what looks like a minor short squeeze, which is able to reset open interest lower while the gold price rises. You can see in the red rectangle here, falling open interest from looks like to be about 570,000, maybe closer to 600,000, whatever that number is exactly, down to about 500,000, 510,000. So we had a closing of about maybe 70,000 contracts as the gold price went from 2350 to about 24.70 or something. So this is the definition of a short squeeze: contracts closing out, short positions closing out, and the price rising. It wasn't an insane short squeeze. It wasn't a non-manageable short squeeze, but it was a short squeeze, and it keeps the price supported as open interest resets lower. I want to see this go below or at least at 450,000 before I call the next rally ready in terms of the fuel available. Doesn't mean it would start exactly when we hit 450,000, but a lower open interest means that when the next rally does happen, we will have fuel left for it. And now gold has been taking off versus commodities. Silver is hanging on at the 200-week moving average, but gold is really taking off versus other commodities. So we're seeing that the commodity complex is suffering now, and I think this is the signal of an impending recession, which is why commodities are falling. So gold isn't falling along with the commodities, which means that the gold to commodities ratio is rising. We're back at 9. We've only hit 9 once. If you take this area that's above the 9, right, and just write that off to lockdowns and insane policies for controlling microorganisms or pseudo microorganisms, or let's not use any other bad words. So if we just take this out as in a period of especially acute insanity, then the high here is really at 9, and we're at that now. So gold to commodities is at an all-time high, excluding this little period over here, which I think we'll get back to, but not because of anything similar to what happened back then. It will be a monetary crisis instead. And I wanted to talk about bank reserves. I've been waiting for these things to fall below 3 trillion. It doesn't look like it's happening just yet. We had a big rise to almost $200 billion this week. This is the weekly change in bank reserves going back to 2021. And this is the third biggest week in increase in bank reserves since 2021. Right here, what was this? This was the regional bank bailout, which you would expect that would increase bank reserves because he had an enormous bailout of the banking system in March 2023, which is why we had a big influx of reserves from the Fed into the banking system over here. And over here, I don't know what that is. It's July 7th, 2021. I don't know what was happening back then, but this is the third highest since 2021 of influx of bank reserves. Why is that? Well, because we had this huge sell-off on Friday of last week and Monday of this week, and people were freaking out about it, and it was all over the financial mainstream media. And like banks started to insist that the Fed cut rates now. Inter-meeting, there was the rumors of an emergency Fed meeting that Chris texted me about, and I was driving at the time. I didn't know what he was saying, and I got kind of excited. But this is a big influx in bank reserves.
In today's news recap, silver price returns to the upside as recession fears allayed. Silver price snapped a 3-session losing streak on Thursday as it rose by 1.2% in the European session. Silver is finding stability as the market repositions itself for impending interest rate cuts by the Federal Reserve. Most analysts opine that the sharp declines witnessed across the board this week was mostly panic-driven correction with no data to confirm recession claims. Markets returned to the upside in the last 2 days after flashes of Black Monday triggered panic. The recovery has shifted attention to the Fed with speculations of potential deep cuts of up to 100 basis points. This has restored confidence that a recession could be averted and could provide support for silver price in the coming days. The gray metals industrial demand outlook had recently taken a hit after disappointing economic data from China and the United States. The 2-hour chart below shows that silver price is currently on an upward momentum. Silver price will likely be on the upside trajectory if the action stays above the $27 pivot, as seen on the 30-minute chart. With the buyers in control, the pair will likely encounter the first resistance at $27.20. However, extended control could break past that barrier and send silver higher. On the other hand, a move below $27 will signal a shift of control to the sellers. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button so you do not miss out precious metals recaps.
Due to the sell-off, this is going all the way back to 2008. The weekly fluctuations in bank reserves, you can see that we've hit here. If you count here, it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So we're in the top 12, 13 of weekly changes in bank reserves, there was a lot of panic, and that's why reserves increased. And let's talk about when they are going to fall fast, and that is when reverse repos finally drain out. So I made here an isosceles triangle. You can see here that for 20 months and 15 days, the reverse repos went from 0 to the peak of 2.553 trillion. And I mirror image that line here. And if you take the same amount of time, 20 months and 15 days from December 30th, 2022, which is when this peak happened, would take us to September 15th, 2024. It could be a little bit past that, but it's not going to be much past that. And here's why. What causes the reverse repos that the government's reliance on T-bills to fund the deficit risked a rerun of the 2019 repo crisis. So what Fry here represents is that as bills are going to increase in issuance and net issuance, we're going to pressure the banking system to enter a new repo crisis, according to these smart people, according to Robin Wigglesworth and Dugowid. Here they say blood pressure already raised. Next week's quarterly refunding announcement, in which the Treasury Department makes public their borrowing plans for the coming 3 months, could make budget hawks faint. Well, let's go to that quarterly refunding announcement, because this article is 2 weeks old. And so we have the Treasury quarterly refunding announcement from Bloomberg. And here we see U.S. plans to hold note bond sales steady for several quarters. Now, the proof is in the inference from that title. Note and bond sales are long-term debt. If note and bond sales are steady, that means that bill sales have to rise. The bills are what are taken from the reverse repo money to the bill auctions. So we see here, they say this outright. The Treasury Department said in a statement Wednesday it will sell $225 billion of securities at its so-called quarterly refunding auctions next week, which span 3, 10, and 30-year maturities, notes and bonds, long-term. Dealers had widely predicted that outcome, seeing the department as able to make up any funding shortfalls over the period via more bill sales. So basically, Treasury bill issuance is going to go up. And more specifically, we have this paragraph on the trajectory of the sales of bills, which take their dollars from the reverse repo facility. The department said Wednesday it expects to modestly increase the offering size of short-dated bills being auctioned next week, then keep that cadence through August. It sees modest reductions in early to mid-September when certain taxes are due. Over October, it anticipates increasing all bill auction sizes, given the fiscal situation. So,
what do you think of today's episode? Is Rafi Farber correct? And we're just months ahead of a massive recession. Are you worried at all? Share your honest insights in the comments section down below, and tell us if you're still buying the dip or just holding strong because you think gold and silver will go lower with the rest of the markets. Now check this video right here because you'll love it. I'll see you on the other side.